Hello everyone and welcome to Openpay's FY21 full year results investor briefing. My name is Jane Lowe and I'm the Managing Director of IR Department, and it's been a pleasure to have supported Openpay with investor relations through what has been a very strong and exciting FY21. Thank you to all who have made time to join this call today, where we will discuss the full year results as well as the announcement that was released to market of another B2B win for Openpay with Kyriba. So presenting today will be Group CEO and Managing Director Michael Eidel, Group CFO Jussi Nunes, and US CEO and Global Chief Strategy Officer Brian Shniderman. Michael, Jussi and Brian will present from the presentation that was lodged with the ASX this morning. The formal part of the session will be followed by Q&A. If you'd like to ask a question, you can do so at any time by entering your question into the Q&A function below. So with that, I would like to now, we'll start screen sharing and I'll hand over to Michael Eidel. Thank you, Michael.
Thank you, Jane, and good afternoon, everyone. Thank you for making time to attend today's annual results presentation. In my update, I will focus on three main aspects of this financial year's results. First, our business performance along our key metrics. Second, some key achievements during the year. And third, following Brian's update on the US and Jussi's section on the financials, Openpay's strategic outlook and what you can expect from us in FY22 and beyond. We will focus on some key slides. For those who are new to the company, a very brief introduction. Openpay is a merchant-led provider of longer, larger and highly customizable payment plans in business to consumer, B2C. We focus on verticals such as health, home, auto, education and bigger ticket retail. These features and industry focus stand us apart from our peers. Increasingly and very much by design, Openpay's growth is being driven by integrations with large aggregator platforms and ecosystems in all our geographies, Australia, the UK, and soon to come the US. We have also successfully entered the very lucrative business-to-business B2B market with our unique trade account management platform, OPY, a software as a service, which is an important pillar of our global strategy for growth and midterm profitability. This year, financial year 21, Openpay has successfully transformed the business to become a truly diversified global payments fintech, well beyond our great buy now, pay later origins, and precisely as described in our long-term vision and strategy. So let's go into the details and proof points of this execution, and starting with our business performance on page 5. Thank you. The increase in active merchants in FY21 was record-breaking. This leading indicator was up 73% year on year to 3,800. Compared to prior years, this is the highest increase of new active merchants by number on record. To scale our business more quickly, we have focused our distribution efforts on large brands, aggregators, and platform partners where it requires only one signed agreement and one technical integration to get us highly visible and defendable into the stores and websites of thousands of merchants across all verticals and 10 and 100,000s of customers, driving customer acquisition, utilization, and volume at scale. The strong active merchant growth was complemented by a strong increase in active customers, finishing FY21 at 541,000, up 69% year on year. More than half of all our active customers is new in the UK. The record high percentage of plans from repeat customers, which stood at 84%, is a testament to our strongly engaged customer base. Another great milestone in FY21 has been cracking 2 million active plans, up 141% year on year. This is quite remarkable considering the tenacious lockdowns in the UK and in Australia and their impact on in-store plan origination, particularly in healthcare. It demonstrates the value of building a diversified portfolio across retail and specialist verticals and the resilience of this strategy. To fully understand our differentiated approach, the probably most important key metric on that page is that 91% of our payment plans are 3 months and longer. Our exposure to the increasingly crowded and convoluted competitive landscape in Pay in 4, Buy Now, Pay Later, is very limited. For us to offer 2-month plans, so Pay in 4, is to meet merchant needs on request. For our TTV volumes, they only play a minor role. The great progress on active merchants, active customers and plans has translated in a 77% growth of total transaction value to $339 million. This is before adding our recent acquisition Payment Assist TTV of another $143 million, which makes us a $500 million TTV player on group level, bringing the unit costs of doing business down significantly as we integrate the two companies. Jussi in his part will provide the details how TTV growth has translated into our P&L, cash flow and funding position in FY21. Let's switch over to the next page, page 6. Thank you. I'm really pleased to highlight some major achievements which have not only contributed to the strong operating performance in FY21, but set us up for a step change in diversification and growth in FY22 and beyond. Starting on the left with our home market. Australia remains our breeding ground for winning and growing new verticals and partnership models. To give some examples, we entered hospitals, a completely unpenetrated sub-vertical in health with St. John of God's. We won large aggregator deals and went live with vertical software providers such as Pentana and Automotive and many more. And importantly, we have proven that we can enter and nurture global partnership with aggregators such as easyvet, a long-standing relationship in Australia, very successful, and our launch partner into veterinary now in the UK and in the US. On the second column in the UK, we have demonstrated continued strong business momentum with 3-digit growth rates in all leading indicators and won some very significant aggregator deals with payment processors and vertical software providers in the UK as well. I will talk about the acquisition of Payment Assist in Automotive in a moment. We also launched our healthcare vertical in the UK with, as I said, easyvet clinics in veterinary and signed some pilots in dental to get the product right. There's no better way to demonstrate our strategic focus on our verticals and to accelerate the entry and growth in these target industries in what we have demonstrated over the last 12 months. The even bigger prize to the third column is awaiting us in the largest consumer market globally, the US. We have confirmed to go live with easyvet in early October 2021 to start with. Brian will provide the details in his update. One further to the right, for our software as a service account management platform, OPY, I will provide a more detailed update in a moment about 4 major achievements in the last year, which has started with our first B2B enterprise client in Australia, a very promising uptake and trading momentum since then, and some recent partnership deals which take OPY also international. And finally, and on the right, we continue to innovate and add capabilities to our tech platform. Our new e-commerce customer journey has already increased conversion rates in the UK very significantly and will now also be rolled out in Australia. Another example, our automation of merchant onboarding has contributed to our record increase of active merchants. And we have prepared to deploy our proprietary automated risk management ARM system in the UK, which will reduce our losses from credit and fraud risk for a high quality receivables book. This has been a brief overview of the key metrics and developments in FY21, which we are very proud of. Now we will provide a bit more color to 3 major achievements with strong strategic and commercial impact for us going forward. Our M&A deal in the UK, as mentioned, with Payment Assist, the new B2B SaaS platform OPY, and then provided by Brian, our launch in the US in a moment. Starting, thank you, with Payment Assist on page 11. As mentioned, our pivot into our specialized verticals will be strongly supported by our anticipated acquisition of Payment Assist, a leading installment plan provider in the UK automotive market. Whilst it is a signed deal, I say anticipated because it is subject to conditions precedent, including approval from the UK Financial Conduct Authority, the FCA. The process is already underway and we expect a positive outcome, which means the approval in the course of the first half of this financial year, FY22. The acquisition of Payment Assist is a very significant stepping stone for Openpay to become a leader in our chosen verticals. Here, our longer, larger, and more customized payment plans can deliver substantial value. And we will generate a healthy revenue yield as a precursor of sustainable profitability. Payment Assist added, the UK standalone is well progressed to becoming cash positive, which is a strong testament of the commercial viability. Importantly, and in keeping with our global strategy, the automotive vertical brings also significantly lower exposure to credit and fraud risk than fast-moving small ticket retail. If you look at the numbers on group level, the two entities combined will more than double our active merchants globally to 8,200, increase our active customer base to more than 700,000, and increase TTV roughly to around $500 million. The successful completion of this transaction provides Openpay also with the FCA credit authorization or credit license, which is consistent with our responsible approach and strategy to enter the regulated credit market. Being regulated will be a clear competitive advantage from our perspective to many of the Pay in 4 providers, and we will be well equipped to meet the regulators' responsible lending and affordability requirements here in the UK. Second, on page 12, I will talk about OP Pro, our SaaS trade account management platform in B2B. OP Pro is a game-changing product for our business. It really positions us as a diversified global provider of payment services, not only in B2C, but also in B2B. The estimated size of our home market, Australia, for our SaaS platform is $233 billion, which is huge and largely untapped. And obviously the opportunity only increases when we size up the addressable market in the UK and in the US. And as we have seen today, we have already made a very significant step into the US based on this partnership with Kyriba. Since we went live with Woolworth, our inaugural enterprise merchant client in September 2020, we have onboarded more than 5,000 of their trade customers and seen a strong increase in trading volume, resulting in revenue and contribution to our bottom line already. Based on demand in the market, Openpay has entered a partnership in April 2021 with Lumi, a fintech provider of trade credit, to add a lending option integrated into our software as a platform service. This combination has proven its value very quickly, as we have already signed a merchant agreement with tech giant HP, formerly Hewlett-Packard, which will go live in due course. And only today, we announced our strategic partnership with Kyriba in the US to introduce our OP Pro SaaS solution for B2B payments to their clients, to improve their working capital performance and strengthen customer relationships. Kyriba is the global leader in cloud treasury and finance solutions, delivering mission-critical capabilities for cash and risk management, as well as payments and working capital solutions to over 2,000 corporate clients worldwide, in part very large businesses. Think of Kyriba providing us with access to 2,000 of the Woolworths and then into their business customer base. A very exciting first international deal for OP Pro. Woolworth and their buyers' strong usage of our platform, the partnership deal for business credit with Lumi, and the recent wins of HP in Australia and Kyriba as an aggregator in the US are of groundbreaking importance for us to diversify our offer as a global payments fintech. This brings us to the third major milestone, the launch of our US business. And this is Brian's part. Over to you. Thank you.
Turn my mute off. Thank you, Michael. Hello, everyone. I'll provide on page 13 an update on our US go-to-market strategy and an update on the progress against what many of you already are familiar with, our 6-pillar strategy for success. So let's start with the first pillar, pillar number 1, recruiting strong leadership. One of the things that's really essential to our plans to enter the US market in a safe and very scalable way has been the recruitment of absolute top talent. And I can confidently say that we have hired a truly unmatched US leadership team with decades really of experience spanning payments, fintech, regulatory, retail, banking, and very specific experience related to our target verticals of healthcare, auto, home improvement. They come from the regulator itself in the US, from some of the largest US consumer lending giants, and from the global payment companies. So our leadership is in place, and they're prepared for launch in just 60 days. Having now filled key roles in risk, product, data, marketing, customer engagement, growth, merchant training, which was an important point that was brought out and asked in one of our earlier investor calls. How are we going to train those thousands and thousands of merchants electronically? So these are experts that bring 10, 20, and in some cases, 30 years of prior experience at really high caliber organizations like Deloitte, Visa, WorldPay, Experian, American Express, MasterCard, as I mentioned earlier, the regulator, the CFPB, the Consumer Financial Protection Bureau, the US Bank, On Deck, Citi, Merrill, and many, many others. So it's a great, great experienced team. Next, let's look at pillar 2. And this is launching a wholesale merchant strategy and a distribution model. Central to our overall strategy is our wholesale distribution model. This is where we're signing partnerships with merchant aggregators across these key verticals, as well as some of the solution providers that serve those verticals. Think of the patient management solution used by most dentists, or the vet clinics and the solutions that provide them services in their offices, or the dealer management systems that are used by most of the US auto repair shops. These are the organizations, the aggregators, that give us access to many, many merchants at a time, as Michael was saying earlier. So rather than relying on one-to-one merchant acquisition, also often called the ISOs, the independent sales organization model, one of these partnerships alone gives us access to as many as, in one case, 94 million consumers. That's via their medical providers. One example that I can share that's been made public is our agreement, as Michael said, with easyvet in the healthcare vertical and the veterinarian subvertical, where we've leveraged the original contract that we signed in Australia by our parent company to expand the partnership for the US. And earlier, we also expanded that partnership in the UK as well. easyvet has more than 2,000 practices globally, and 1,200 of those are actually in the US. Additionally, we're in very late stage negotiations with a significant number of other aggregators across our target verticals. And it really gives us great diversification across multiple sub-verticals within and across those target verticals. Let's turn to pillar 3, creating large-scale sustainable ecosystem partners. As great as that second pillar is, those aggregators for achieving vertical penetration in healthcare, auto, home improvement, education, we actually access even greater scale from agreements with the leading payments processors and the e-commerce platforms, which provide us more horizontal vertical coverage. The best example is the agreement we signed with one of, if not the world's leading payments processor, where we'll be integrated into their actual payment gateway for online transactions, as well as in their point of sale at the purchase point. They process 75 billion transactions for merchants a year. They didn't have a BNPL solution, let alone a buy now, pay smarter solution like we offer. And we're the solution that's going to fill that need in the US first, and then in all of our markets globally. Additionally, in late stage advanced discussions, we're having agreements developed with 2 of the largest US and global payment companies to begin piloting OPY in the first half of 2022 calendar. Our focus on large-scale ecosystem partnerships is not limited to just OPY, our B2C product, but also now includes OP Pro, our B2B SaaS platform for trade accounts that Michael talked about earlier. There, as mentioned before, we have announced a major partnership with Kyriba, which is a US-based global leader in treasury and payable solutions. And through them, we'll offer access to our OP Pro B2B SaaS platform to Kyriba's US-based enterprise clients. These are very, very large corporates, as Michael mentioned. We'll start with an initial phase of pilots. And I'll talk about these pilots in a moment. This will go out to their enterprise clients through a referral model where we will together begin working on bringing these critical customers of theirs on board with our solution. 2,000 enterprise clients. This is our first step at taking OP Pro to the US market, and we're really excited about the potential we see there. We know that just in the US alone, the combined revenue figure for Kyriba's enterprise clients is in the trillions of dollars. That's how much money moves from the seller to the buyers. With further discussions with our partner about their customer base, we see that many are either entirely wholesale and manufacturing clients or have partial B2B solutions. It's really key for OP Pro to bring out its value. And the combined revenue for that group is well over, as I said, $1 trillion. So this gives you a sense of the transaction and payment volumes that we're talking about, and where our OP Pro solution helps ensure it is transacted and managed end-to-end in an automated and efficient manner. One other point I would like to make here in relation to the importance and the power of these pilots in our go-to-market approach. As I said earlier, central to this overall strategy is this wholesale distribution model, where we rely on partnerships with vertical aggregators and solution providers and with leading payments processors and e-commerce platforms. These large aggregators, like insurance companies, by nature, they're very risk averse. And they drive massive amounts of volume when they're up and running, like factories, but they're very risk averse. So to address that adversity, we're starting with about a dozen pilots that are designed to transition into controlled rollouts, rather than, as you can imagine, starting and stopping programs with proof of concepts. They're pilots, but they become controlled rollouts. And that helps us to ensure safe scaling at these largest payment companies in the world with both our OPPay and our OP Pro products, starting again with the US. Let's take a look at Pillar 4, provide an update on Pillar 4. So we're leveraging the existing platform that we have in Australia and that we use around the world already, while integrating all of the requirements for a fully licensed and differentiated platform that's tailored to the US market. We're also in advanced negotiations with banking and funding partners, and we will be ready to launch in the US within 60 days. Pillar 5, product tuning, designing this for the US merchants by the US merchants. So we attracted senior US merchant executives all the way up to the top C-suite CEO level to participate in user groups to help us design, build, and customize our platform for optimal functionality in the US. We launched it and called it the OP Merchant Advisory Council. And it's to help us design and build solutions, ensuring that we get continuous feedback and unique experiences that matter most to the merchants in the US. Pillar 6, pivoting and expanding and scaling from our existing areas of strength. US consumers who use our product safely in a lower risk vertical like dental can take that product and travel it to other adjacent verticals where the risk is typically higher, but because we're taking a very safe consumer, we can actually provide our product into those other verticals. So if you have an active plan with us, or if you've already paid off a plan and you've proven yourself to be safe for, say, a leaky roof in our home improvement vertical, we can help you use that now to go buy the things under the roof that maybe were damaged by that flood. A TV, flat screen TV, or a rug, things that are typically in a riskier space for us. And that allows us to expand and scale. So for that 6th pillar, we have already begun and have advanced discussions with partners in that large ticket retail space. So they'll be ready for the OP customers as soon as they get through those initial originations in our safe verticals. Jussi, over to you.
Thank you very much, Brian and Michael. Good afternoon, everyone. Well, look, from my perspective, FY21 has been a very big year for Openpay, with several transformative achievements that position us really well for continued expansion. Again, from my perspective, this has really been evident through the following results within our regions. Firstly, in the ANZ region, and especially through growth in active merchants of 74% and active plans of 85%, we really expect a continuing strengthening in TTV performance beyond the 47% growth seen in FY21 through repeat usage within our growing customer base. We've launched our B2B offering with a strongly growing customer base and utilization that both generate revenue, plus that now we have a healthy pipeline for both the SaaS and funded product. Secondly, and in addition to our acquisition of Payment Assist, the UK really saw an acceleration in growth across all key metrics to establish itself as a very strong emerging market for us. For instance, it overtook Australia as the largest customer base for the group to end up at 276,000 customers for the year. That is 153% growth versus last year. We did, however, also see early stage losses briefly that had an impact on our profit margins, but which have actually rebounded nicely into FY22 already. And then finally, we did announce our intended entry into the US market, which will happen through our go live in early October with EasyVet, as Brian mentions, which really has required some relatively significant upfront investment, but which will really allow us to win large aggregator deals and access significant volumes within our preferred, more specialized verticals and set us up for required scale growth. So to that end, what I will do today is to outline the impacts of these life cycle maturity dynamics on the business and how they will continue into FY22, after which I'll hand over then to Michael to take us through and comment on our overall outlook for FY22, and then finish off with our Q&A session. So if we go into page 15 at first, thank you very much. And let's stay on this page. I'll talk about page 15 and 16 interchangeably. So if we start on page 15, we really see the headline financial performance metrics we usually cover during our market updates, with the growth of 77% in TTV to $339 million, headlining our Buy Now Pay Smarter revenue growth by 43% to $25.8 million. The revenue margin of 7.6% outlines the mix shift that's been taking place during the year into the retail vertical, based on strong UK growth, which is retail only, albeit with underlying vertical specific margins still relatively stable throughout the year. And please note also that the revenue margin excludes B2B revenue, as it's earned on TTV that is not funded or by Openpay. Then if you look at the net transaction margin or NTM of 60 basis points, we can see that for the year, that was a reduction from last year's 2.5% and was driven by the revenue mix shift towards retail, as well as the earlier stated loss performance in the UK. We have stated throughout the second half of FY21 that the level of net transaction loss or NTL for the year of 2.3% would be temporary, and that we expected an improvement toward the end of FY21 and into early FY22. So then actually, if you look at our July numbers on page 17, please, you can see there in the bottom right corner that we recorded a net transaction margin of 1.7 already, aided by an NTL of only 0.7%. And what's really particularly pleasing, through achieving that strong NTM, is that we also grew our other key performance metrics of active merchants to near 4,000, up by 77%, active customers to 556,000, up 64%, active plans to 2.1 million, up 130%, and TTV now nearing 36 million, up by 50%. So, all in all, great start to FY22 as well. The only point I'll mention from page 16, and no need to go back to that page, is really the average receivables turns of 4.6 times for the year. That's accelerated slightly again, and is due to the shift we've had towards the retail vertical. Thus, while TTV continues to grow strongly as expected, the receivables themselves have grown at a lower rate due to increased capital efficiency of the book. Okay, if we then turn to page 18 and the main points around our P&L performance for the year, we already noted the income growth to 26 million with a percentage growth in the mid-40s. Additionally, the main contributors to the 63 million loss for the year include an uplifted cost profile by way of investment in human resources of 27.7 million through the employee benefits expense line. This was really to complete the development of our SaaS platform, OPY Pro, and to get the US ready for launch later this calendar year, all to drive top line growth. What is important to note also about the dynamics from last year to this year is that we came off of a lower cost base in FY20, where cash preservation initiatives due to economic lockdowns and its impacts included managing staff-related costs. Secondly, we did also note an increased marketing cost line that ended up at $7.2 million for the year. That comprises to a large extent acquisition and integration costs for significantly increased merchant and aggregator partner base that will deliver strong future TTV growth. Finally, we also saw an increase in the other expenses line for the year, which represents majority of the investment made into setting up our US entity and other capabilities for US launch. Now, just on that cost performance as well, please note that a significant portion of the invested funds into our US launch are one-off in nature, with a stabilization of our cost base and subsequent reduction in many areas expected during FY22. There will be, or having said that, there will be continued investment in the US team and other resources required, but this will be balanced by savings from not having to incur those one-off costs that we've seen in FY21. Also note, we did have some significant one-off expenses due to the acquisition of Payment Assist, which we don't expect to have in FY22. Then page 19. Thank you. Page 19 outlines our financial position at the end of the year, with total assets virtually stable, albeit with a cash balance of 52 million after a capital raise performed early in the year, and an increased receivables book by 20% versus prior year, ending up at $58.5 million. Furthermore, on the asset side, I'd also just note that the company started to capitalize more of its platform development costs as per internally developed frameworks, which is why you see an increase in the intangible assets line as well, slightly. On the other hand, our liabilities have also increased due to portfolio growth and working capital intensity, which is visible on our payables line, and also with the growth in our lending book in the form of drawdown borrowings to support our TTV growth. What you will be seeing in early FY22 is further progress on our lending facilities, especially with regards to our launch in the US. On the group's cash flow statements on page 20, we can see that increase in cash consumption required for our US launch reflected in the payments to suppliers and employees line, which was, however, countered by an actual net positive cash flow generated from higher receipts from customers versus payments to merchants. And you're really driven by that trend in shortening tenor of our book during the year. And finally, investing cash flows were impacted by investment into platform development that was capitalized, whereas the major differences in financing cash flows year on year were driven by a smaller quantum of capital raised during FY21 as compared to FY20. Thus, our expectations of some operating cash flows, similar to the point I made on expense management earlier, is really that they will stabilize in FY22 as a result of not incurring certain one-off costs that we've had seen. Okay, and look, that is all I wanted to say to cover from the financials perspective. Over to you, Michael, for the strategic outlook into FY22 and wrap up before we open for Q&A. Thank you.
Thanks, Brian and Jussi. Really packed FY setting us up for with scale in all markets and a very promising start already in our first trading month in July. Just to summarize, in FY21, we have made significant targeted investments in new geographies such as the US, as we have heard from Brian, new verticals or sub-verticals such as education or hospitals. We have enhanced capabilities to manage fraud and credit risk. We have acquired payment assist with the required one-off costs. And we have invested in our B2B SaaS platform in partner merchant and customer acquisition. All this to strengthen our position as a differentiated provider of payment services in a fiercely contested market and to diversify our revenue streams and accelerate growth. Our high revenue margin from the outset and the opportunity to scale now in the US and also now in the UK in our verticals, plus reducing unit costs, will make us a profitable business in the midterm at a significantly lower required level of TTV compared to many of our competitors. I want now to take the opportunity to address some strategic considerations going forward, starting on page 23. Thank you, which very clearly outlines our differentiated approach. So we do not believe that our approach to consumer lending should see us focusing on pay in 4, buy now, pay later on the bottom left here, and thus on the mostly applicable retail sector, which is low value, fast moving fashion and footwear, often for very young people and for what they believe they want versus need. This area is already well covered by large traditional buy now, pay later providers, and it is the principal use case for PayPal, Apple Pay Later, and the banks, which now have come to the party as well. In fact, looking more to the upper right, Openpay in our verticals of bigger ticket retail, and then our verticals auto, health, home, education, etc., creates a very different customer experience when and where a longer tenor solution will be utilized. Consumers in moments of unexpected need, hospital visits, broken transmissions, root canals, leaky roofs, Brian's example, veterinary surgeries, these consumers are more likely to use the solutions proposed by the merchant. In our view, it is unlikely that in these moments of need, consumers will turn to these above-mentioned tech companies or banks. Instead, from our perspective and experience, consumers will turn to the provider proposed by their doctor, their veterinarian, their auto repairer, or their school, where trusted relationships exist and count. So Openpay as a trusted partner of the merchant and finance-savvy customers. This leads me to the next page, page 24, which illustrates how we do not only differentiate from a product perspective, but also gear up the penetration of our products across geographies, which is our distribution strategy. From our origins, that's the small dot in the middle, we have acquired merchants individually, integrating and supporting them to bring our installment plans to their customers through education and co-marketing. And nothing wrong with it, and we will continue to do it. However, over the last 12 to 18 months, we have pivoted our distribution strategy fundamentally to provide smaller merchants with a self-service capability to onboard themselves, which has worked really well, as we have seen, and to focus sales on large ecosystem partners, such as the world-leading payment processor, who we will integrate into. And by the way, their sales force will be our extended sales force to get us into their merchant base, and aggregators such as dental service organizations, vet clinic or car dealership software providers in our buy now, pay later verticals. Same principle, they all provide thousands of merchants with our longer, larger and verticalized plans and drive accelerated growth and scale. And very nice to add, our deal with Kyriba follows the same approach, a treasury management software provider to take OP Pro to their 2,000 in parts very large corporate clients into B2B. This aggregator and ecosystem approach will be complemented by targeted acquisitions or joint ventures, with specialized providers of differentiated buy now, pay later in our target geographies and verticals. And a great example is Payment Assist, to de-risk and accelerate the market entry and growth. We will continue to look at suitable inorganic opportunities, partnerships as we further develop our business. Now over to my last page 25, and to make it very tangible, my management team and I will continue to meticulously deliver on our long-term vision and strategy to strengthen our position as a diversified global payments fintech and to drive scale and midterm profitability over the next few years. Key achievements, amongst others, in FY22 will be the integration with the already signed global payments processor and more vertical aggregators, which will mean a quantum leap in volume growth, and the proliferation of our SaaS platform in B2B beyond Australia. And we have made a great start on that journey already. And to be very targeted in where we spend our investors' money. We remain committed to make our business a fantastic global offer and experience for our merchants, our customers and partners. Very much forward to keeping you and our investors updated on our progress. Thank you. And with that, we will now enter the Q&A part of the call, moderated by Jane. Over to you, Jane. Thank you.
Thank you, Michael, Brian and Jussi. I would now like to open up the session to questions. If you'd like to ask a question, please type it into the Zoom Q&A function via the ribbon on your screen. We have about 10 minutes left on this call. So if you have a question that we don't field in the time that we have, please feel free to send it through to investors@openpay.com.au after this session. So I might throw the first question to Jussi, and thank you to Jussi Nunes at Shaw, who's sent through a whole set this afternoon. So Jussi, a big talking point in the market for all BNPL players, including Openpay, is the massive acceleration of costs as all players drive entry and scale into the UK and US, etc. Given the explosion in losses reported from Afterpay and Zip yesterday, net losses of 159 million and 653 million respectively, on an upsurge in costs as they ramp up overseas, how should we view Openpay's FY22 total OPEX versus the 81 million in FY21, and what percentage of the total OPEX in FY22 will be allocated to each of the US and UK specifically, please?
Thank you, Jane, and thank you very much, Danny from Shaw and Partners. Maybe I answer the second part of that first. So these kind of split into UK, US without giving too specific numbers, but beyond the payment, the upfront cash payment, as has been outlined already for some time ago for the Payment Assist acquisition, UK region won't require much of a significant uplift into investment, which was something that we have already stated before. So in terms of, if you actually look at the investment focus from an OPEX perspective compared to what's already there today, it will be skewed towards the US. With regards to the $81 million of OPEX in FY21, as I mentioned before, that did include quite a lot of one-off expenditure, which was really invested to get not only the B2C, but also the B2B platform ready for US entry. So what I see as a dynamic going into FY22 is really especially compared to the second half, so the last 2 quarters of FY21, I see a significant stabilization of our operating expense profile, and even a reduction in some cases to kind of stabilize and almost even reduce that cost base. So we will not have a recurrence of a lot of these one-off costs, but what we will do as well is to continue to invest in the US, which means continuing to build the team and some of the other capabilities that are there. So a stabilization, but a bit of a shift in what those costs are, so that you will not see those stronger cost growth rates nor cash flow consumptions as you have seen, especially in the last couple of quarters of FY21.
Thanks, Jussi. A question for Brian now. In regards to the US launch, which is coming soon in October, How is brand awareness tracking? And is there likely to be more spend in that area? And or are you expediting awareness and uptake by partnering with tier 1 aggregators like Worldpay and Kyriba to drive quicker engagement and adoption and lower customer acquisition cost? That's part 1. And what is your thinking around perhaps a US acquisition to drive ecosystem scale more quickly? Part 2.
Well, you did a beautiful job of answering your own question. Yes, our distribution partners are very much a part of our brand distribution. So we work very closely with these big aggregators and ecosystem partners like the big processors. Yes, you'll see our brand right alongside their brand. You'll see us branded with things that are very familiar, whether it's an EasyVet, whether it's a dealer management system and the dealer. So you'll see familiar places associated with OP's brand with the consumer. But this ties also back to something that was asked of Jussi on the last question. You see, we're not doing this like an ISO, right? Going door to door to merchants. That's very, very expensive for our competitors to do. You have to throw a lot of capital at that. So through these ecosystem partnerships and these merchant aggregators, we can piggyback the branding and marketing that they already do. It's much, much more efficient. So I just wanted to connect those two dots. But yes, I think you've nicely tied that together. Look, as I'm sure Michael will tell you, and as the global strategy officer, we're always looking at opportunities, organic and inorganic, that can accelerate our growth or that can give us an opportunity within our verticals like payment assist, that get us very deeply integrated into the verticals. And importantly, the solution providers, again, that provide the software into those verticals. So we're always looking at those options is the best way I can answer it for you.
Thanks, Brian. And you may have delivered a nice segue into the next question, actually, which is perhaps for Michael. So the integration of the Payment Assist acquisition in the UK appears to be on track for the first half of FY22. Given they did calendar year 20 TTV of £78 million and we're targeting growth of 35% on a calendar year 21 TTV of £105 million, how do you see the post calendar year 21 growth of that business? Is it still over 30% annually?
Thanks, Jane and Danny, for that question. I'm currently in the UK. I've escaped Australia for the next few months, and I'm working very intensely with Payment Assist on site on exactly the kind of exploitation of growth synergies which we had identified. And I'm very, very excited about how they have set up their business. We have already identified within their existing remit in automotive further significant growth potential. There's just one example where a very large Payment Assist client in automotive, who is also serviced by a very, very large competitor here in the UK, Payment Assist will probably take all the volume going forward because this car dealer is not happy with the other provider. So that's within an existing relationship, a massive opportunity to grow and scale, just because they have done a very, very good job to provide a very responsible product through the car dealer to their customers. So more growth to be seen, and I think at least at the same growth levels beyond FY or calendar year in the UK 21 and 22. And on the other side, we have also identified significant opportunities without additional investment to together enter new verticals. And they have a non-integrated platform for in-store. We have a beautiful integrated platform, which is very suitable for getting into these large aggregators. So we can really take our existing assets and make 1 + 1 = 3 without additional investment to capture more opportunities in other verticals and drive volume and revenue. So very, very exciting acquisitions, even more now as I'm on the ground and see things happening.
Thanks, Michael. I might throw this next question to you again about Australia and New Zealand. So Australia and New Zealand will no doubt become a smaller part of your business as the UK and the US ramp up over the next 12 months. Are you concerned that the growth rate in active customers has slowed year on year to 26% versus much higher growth rates for merchants and plans? And was there any material impact from the recent shutdowns in July in New South Wales and Victoria for the Australian business, which is referring to COVID-related lockdowns for our international investors?
Yeah, thank you, Danny, for this question. First of all, Australia may become smaller in relative terms, but is still a very, very important market for us, as I said before, to explore new verticals, sub-verticals, to partner. And Easybet is a beautiful example of a long-standing relationship in Australia, which we can now take global to inform the market entry into our key verticals in these geographies, UK and US. So very, very important going forward. With regard to the increase of active customers in FY21 in our home market, I'm not concerned, because what typically happens is our business is a merchant-led business. We don't advertise directly via a virtual card, for instance, what other competitors do, independent of the merchant into the consumer base to make them buy wherever. This is why this is called an everywhere buy now, pay later. We are very strongly merchant-led business, and I think what the numbers have shown in Australia, an increase of 74% of active merchants during the year, and this will then over time, as we integrate in their platforms, including the aggregators, then lead to an increase of new customers. Again, there's always a bit of a time lag in acquiring new merchants and then seeing the active customers coming through. So from my perspective, the leading indicator, active merchants, has been extremely positive in our home market, and active customers and plans will follow.
Great, thanks, Michael.
Yeah.
I think you have. Thank you. So I'm conscious we've got about 1 minute left, so I might just throw the last question out there, which relates to the US again. Michael or Brian, for one of you, perhaps Michael, you can decide. So how quickly can we expect to see the US revenues kicking in is the big question. Yeah.
Well, I can start and then over to you, Brian. Obviously, we are very, very excited for seeing now what we have talked about for a while, the 6-pillar plan being now executed largely, and that we will now be in the market in early October with Easybet and more to come, these pilots, which will really demonstrate the differentiation of our product and the added value for merchants and customers. So what we can really expect from October is now different to before, seeing TTV and revenue coming through. We want to take a cautious approach. We could go big bang with some of these aggregators from day one. This would not be wise. So we will be smart in piloting and then morphing from a pilot or from pilots to controlled launches, and then ramping up the volumes as we see it works for the customer and for also from credit and fraud perspective. But I think the big difference and highlight will be from October, we see TTV and revenue coming through in the US. Brian, any further?
Well, you covered it pretty well. The one image I'll leave in everybody's mind is we are building factories, essentially, of volume in the US in each of these verticals, big factories. That's what these ecosystem partners and aggregators are going to provide us. But you don't turn the factory on all at once, because all hell will break loose. So you really carefully open the spigot, and that's what we're going to be doing. So yes, absolutely. You'll see TTV, you'll see revenue in October, and then you'll see a significant ramp up next calendar year in the first and second quarter. Things will start to get very exciting.
Some great sound bites there, Brian. Thank you. That's a terrific spot to end on. So Michael, I might hand back to you just for closing comments, and then we can let people move on.
Yeah, thank you very much, ladies and gentlemen, on the call today for joining us and kind of following the progress of our company as we scale and grow globally. I look very much forward to updating you soon on our progress. And as always, if you have any further questions, please contact our investor relations team or reach out to me or the other people, Jussi and Brian, directly. And thanks again, and have a good day and evening.